up, Stocktwits Nation? It is Tuesday, July 22nd. I'm Katy Perry here with Shay Boloor. This is the Daily Herb Live, and we are here with Jake Wu. What's up, guys? I wasn't here for a couple days. What did I miss?
I think you and I both weren't here yesterday, so
Oh,
it's been a
right.
minute. I know. We probably look very different. We're 4 days wiser, everyone. So watch
We
out.
are. What did you? Well, yeah. What did everyone do without us? The market hit all-time highs. We missed that yesterday, I guess. Jake, how have you been since we saw you last week?
Good, can't complain. It was a very solid week last week. China names finally got their bump, so we'll see how they look today in the
All
chart.
right. Was that the highlight for you last week?
Yeah. I would
Okay.
say Baba was one of the bigger trades I've had this year. So I'll
Okay,
take it.
flex on them. All right, we love that. Well, Monday brought all-time highs in the S&P 500 and NASDAQ. Most of the attention, though, we are memeing OpenDoor. It feels like it's 2021 again. You guys have any thoughts on OpenDoor? What's going on there? The flurry around it. Shy, are you? No, you're not like really a meme guy, but are you watching what's happening with that one?
I'm watching as a spectator. I think it's really interesting to see the risk on appetite when you have a name like OpenDoor just go up 600% in a month. I think that's the renaissance of the former SPACs who are left for dead. Some might call it early signs of a near-term top. Some might call it uh, is the market pricing in the rate cuts, whether or not Powell
Mm-hmm.
wants to admit it. Is it coming? If so, is that why Open Door is catching such a big bid? Caveat, I want to let everyone know when Fed cut interest rate, it does not affect short-term interest, like short-term bond markets. It's always a 30-year bond market. So like I don't think that whoever's bidding up Open Door, if it's based on a thesis on Fed cutting rates, it's not as impactful as you would think in the open door case. Like open door is primarily what's going to increase the mortgage demand. And I'm sorry, but like the 30-year rate is the only one that's going to actually move the needle on that. And I just don't think the Fed cutting rates will drastically change that thesis. So I think this is just purely risk on appetite. It's a short squeeze. I want to say it's 30 to 35% shorted. So I think that's it's a trade. Be cautious when a stock goes up 600% on a narrative that might not be an actual reality, and monitor it.
Yeah, I mean it's a Chamath special. I didn't think we would be talking about this one again. This stock was left for dead. Jake, you're deep in these circles, in FinTwit, in these spaces. What are you picking up on Open Door? Is this something you're watching? What are you hearing on the streets?
Well, not a ton, other than it's going up. I'm kind of the same way. When these types of moves happen, we're generally closer to a top than a bottom.
Mm-hmm.
Uh, but that doesn't mean this thing couldn't run to like $7 to $10 randomly. You know, the market cap isn't that big. I mean, it's I think it's 2 or 3 billion. Correct me if I'm wrong. Let me correct myself here. What is it? 2.34 billion.
Mm-hmm.
It doesn't take a lot of retail money and a little sprinkle of institutional short squeeze capital to move a stock very easily at that market cap. So, yeah, I wouldn't short it. I was getting a little bit of a technical signal yesterday with a potential kind of top, but in this type of environment where the market is just the momentum is there and you've got a lot of money behind it, essentially trying to become the next GME. I wouldn't get in the way of that. You're probably going to have a bunch of people think that they're geniuses trying to buy puts on this, and hate to be that guy, but even buying puts on this, if it goes down 30%, you're probably not going to make money on puts because the implied volatility on these contracts is massive. So, yeah, we'll see what happens. But I like to spectate on these. I don't like to play them.
Yep, that tracks. I mean, let's bring it back down to earth because we're deep in earnings. We've got tech earnings this week. Shy, a couple stocks reporting tomorrow that I know you follow closely. Google being one. I know we've had a lot of ongoing conversations about the AI efforts that they're putting forward, potential risk to their search product. That's one. We also have Tesla. I know you've talked before about Tesla earnings. They've reported numbers going into this. Out of those two, which one is there one you're watching more closely in terms of the readout?
So I'm watching Google more closely just because I think there is a lot of secondary effects on their prints. It's not just AI, it's also the cloud, it's also ads. There's a lot more industries that are affected by Google's earnings report to see some kind of pre-read on what the environment is this earnings cycle. But I do want to also reiterate that Google's up, what, a week and a half straight every single day. I want to say it's like 9 or 10 straight green days, something along those lines. And I think that it's been a laggard and it's catching up a bit right now entering the earnings print. I still think it's the best Mag 7 setup this earnings cycle, mainly due to the fact of the over FUD that's been generated on AI cannibalizing their business. Yes, AI will cause search to evolve, but I think a lot of people don't really understand how the evolution is going to go. And that's second to like think about what it's going to turn into is causing a lot of people to have some fear about it. Where right now their whole business model is price per click, the blue link you can call it. I do think that they're inevitably going to go towards price per token, and it's already happening right now. And I think that the market is underpricing how much control that Google has in their vertical integration. That is the name of the game now in this race to super intelligence. You're seeing with Meta trying to acquire their way into that vertical stack. You're seeing the reason why Microsoft is kind of in this weird in between because they won't be able to own it due to the OpenAI relationship. Apple is just clearly struggling as well. But for Google, like they own their own models on their own chips. They have the greatest distribution among all the Mag 7 names. And YouTube is dominating connected TV still. And we're not even talking about Waymo's valuation to their what's at $109 a stock right now. Like Waymo is not priced into that valuation at all. So I do think that even after the run up, the valuation is still very reasonable against its peers. And I do like that setup. For Tesla, let's see if the narrative regains altitude. I think that's what's going to really drive the stock after its print. It's not an earnings story. We know deliveries will be down over 20%. We know EPS will be down in the low teens year over year. It's going to look ugly. But you're going to see Elon show the shiny little metric, the narrative on their earnings about AI and autonomy and Optimus and go away from the EV company because I think it's a world's worst kept secret. Tesla is not an EV company anymore. You're seeing that Elon has cannibalized that business in order to fulfill his autonomy vision. And I think it's worth the bets because EV is not going to be as disruptive as people anticipate. Like a lot of people thought EV was going to be the next greatest thing in the automotive industry. It's not. It's hybrids can do a lot of what the EV offerings can do, was supposed to create. Nobody drives more than 60 miles anymore. The hybrid's good enough. What Elon's trying to build on the scalability of autonomy is something that is the ceiling is so high that if you have the appetite for the risk on physical AI, this is the play to do it. However, be cautious on the tax of owning an Elon company. That's what's the biggest frustration where you have to worry about it's very headline driven. You have to worry about the minuscule fight between POTUS and Elon. There's a lot of secondary effects that are driving the stock price rather than the actual business. That's the frustration. But I do believe the scalability of what Elon's trying to conquer, it's why it's a top 10 position for me. I'm not willing to not be part of that ride because if they truly do build the neural network for mobility and robotics, that is a multi-trillion-dollar TAM that has the scalability of a theme that we've never seen before in mankind, where it's going to touch every part of this world. So it's something that it's worth riding, but know that it's going to be a very bumpy ride.
Yeah, for Shay, for people who aren't like following Tesla as closely as you are, what in these earnings readouts in terms of painting the future vision for the company, how concrete does Elon tend to get in his commentary? Is he going to really lay out concrete details about this future that you're spelling out here, or is it more so kind of you just want to see some confident words behind what he's building, and that's what investors are watching? What can we expect from the sort of the words around the numbers tomorrow?
So the rhetoric you're probably going to hear tomorrow, some lofty targets in 2-3 years. It's not going to be anything in near term. I hope he creates some kind of commentary on the successful robotaxi launch in Austin. Yes, like I know all the bears are saying it's not at scale yet. It's not even tested. It was launched with 10 vehicles and there was a human monitor in the passenger seat. Fine. But that's not doesn't mean it's a failure. That's what people are at the disconnect between the bears and the Tesla bull vision, because how do you scale into the public infrastructure? Stage one, exactly what they did in Austin. You can't do a rollout more aggressive than what they did just a couple weeks ago. So if you're not just trying to build a prototype, but you're trying to actually lay the groundwork for what the global autonomy network is going to look like, that is how you do it. But make no mistake, like Waymo is still the leader in autonomy, but it's a completely different arena that they're both trying to tackle. Waymo is a much higher floor, much lower ceiling on scalability. Tesla's just literally trying to make the car into an actual human. 2 eyes, no LiDAR, none of the the wonkiness that's outside the Waymos. Like they're trying to actually make it a human driver, the car itself, and that's difficult. And the timeline is what's the variable in the calculus on if Tesla's going to be successful or not. So you're on the earnings report this on Wednesday. You're going to hear a lot of narrative on rhetorics of what Optimus, how many robots are going to be delivered potentially next 2 years, how many cities are going to try to tackle on autonomy. But it's not going to be anything too specific, and that might frustrate a lot of the bears. But I do believe that if any kind of narrative regains altitude on that earnings call, this name might catch a bid because the scalability of what they're trying to conquer, it's underpriced right now in the market. Like I know Dan Ives says it's $1 trillion opportunity, autonomy, let alone. Like I do think it's actually far greater than that. It's a multi-trillion-dollar opportunity in the next like 5-6 years. I think Optimus is going to be a much greater opportunity than autonomy, and I do believe that. We talked with Michael, like who was on the show last week. I know him and I disagree on the timeline, the how far along they are in Optimus, but like I do think that if they actually can commercialize Optimus on a far more accelerated timeline than 4 or 5 years, I do think that's going to cause the stock to catch a major bid. But I also don't think the earnings report this week will move the stock at all. I think Elon's in a wartime CEO mode again. You're seeing a lot more commentary this past week via his X account that he's back in that founder mode and working there 7 days a week. And I think that it's also really important to know that the question now for autonomy isn't, it went from if to how long. That is huge, because before people were like, I don't know if it works. Now it's like, how quickly can it scale? That's the first domino fell. And I think should like pause there and like, good, congratulations, you made that first major step. Now it's up to the second wave.
Yeah, we got some, speaking of autonomous, we got some Waymos floating around New York City, and people are losing their, I don't know if New York's the market for the Waymos. There's too many factors that are unpredictable at play in the streets of New York, but they are here. I saw a couple of videos. We also saw yesterday Elon continuing to be just a corporate communications head's nightmare. Usually go into earnings, there's, quiet period. It's like a very a curated message that's going forward. Yesterday he comes out, he's like, I'm opening a diner in LA. It's supposed to be the Jetsons meets a drive-in. There's a theater. It honestly kind of sounds cool. But he is in that mode where he's focused, right? He's singularly focused on this future vision, but also he's always got these random things going on in the backdrop. So that will definitely be interesting one to watch. Jake, I want to go over to you because I know you have a few things you're looking at this week, including Bull, Baidu, which you kind of referenced earlier, Nike. Out of those, where do you want to start today? I know you got some setups for us you want to share. What are you sort of most excited about tracking today?
Well, we can start with Tesla. It's probably a good place to start. I would say, I generally, let's see here. I generally don't play anything into earnings, so it's just too risky for me. If I'm trading, I'd kind of lose my edge a little bit. You never know what's going to happen. But if you do look at the longer term setup, this is Tesla. It's about as simple as a chart as you can get. And it's really just a very basic kind of rounded bottom. You can see this price action's just been chopping around now for the last 4 years. And you've had some volatility in there where you can make some big money in between these highs and these lows, but for the most part, price is kind of stuck, especially if you zoom out a bit. We really are kind of forming this pretty large rounded bottom here. So,
Jake, real quick. When was the last time it had a rounded bottom?
who?
Last time Tesla had a rounded bottom from 2014 to 2020. What happened when it broke that?
Yeah, no, I mean totally.
Yeah,
You've kind of got 3 instances of it. You've got, and it's pretty just, you've got these long periods of consolidation, and then you've just got these impulse moves for like 5 or 6 months. So, I'm not convinced that that's not going to happen again. I think we're very close. I had a position in it last week. I realized that I was breaking my rules getting into a position before earnings, and not necessarily before earnings, but I just didn't want to start. I do know how Tesla has reacted in the past with earnings reactions, and I would prefer to maybe even buy a little bit of Tesla at a premium to what I could buy it at today and erase some of that uncertainty than try to buy it now right before earnings. But overall, the technical setup is there for sure. This thing could literally move back to all-time highs within a month or two, pretty easily, I think. So definitely on my watch list, but as Shay mentioned, there is a lot of kind of headline risk with this. This is one you almost have to trade shares on, because then you don't have to worry about, if you have a 5% down day randomly on Tesla, 5% on shares is nothing. Well, maybe to some people it is, but for the most part, if you're trading options, a 5% change in price is nothing. But a 5% move down in the options market on the spot price could be, depending on what you're in, 30 to 70%. So I think I am pretty close to getting ready to maybe start a position here, but I just am kind of on the fence. Maybe I buy half before earnings, half after. But yeah, this is definitely on the list. But at the same time, my biggest and continued main focus is on China. If you look at HSI, this is about as clean as it gets, and I think I've been on the show long enough at this point to know that we know what I'm looking for. I'm looking for these volume gaps and these volume shelves using the volume profile. So if you look at HSI, it's the Hang Seng Index. We are finally breaking through this diagonal trend zone. So that's one. We are on the monthly chart, so keep that in mind. One, we're breaking out on the monthly chart. Two, we're entering this area where you don't have a lot of liquidity above. You don't really have a lot of liquidity above until you get to around 28,500 on HSI. So if you take, the current price where it is now, that's about a 10 or 12% move. If that 10 or 12% move happens on the index, you're going to see names like Baidu, Baba, JD, probably moving 20 to 30%. So they're clearly higher beta movers, especially JD. That is one that has performed very well in the past when we have these impulse moves within the Chinese markets. So this is what I'm focusing on. But, and this is a big but, remember, this is a monthly candle chart. This is not a daily candle, right? I'm not expecting this to go to 28,500 next week. Based on this candle, it could be maybe by September or October if we really got a strong move. But a 10%, 12% move in a total index is huge. So, that's one of the biggest frustrations I have a lot of the time is I'll post a chart and it will be a monthly chart and somebody will ask 2 days later, well, why isn't this stock moving yet? It's like, well, please keep in mind what time frame we're on. So overall, I am trading options on Baba and JD, but my biggest position is Baidu. I think Baidu is probably the cheapest out of all those names. And, that is one that is just so compressed. It hasn't even really made its move yet. This is actually, talk about long-term timeframes. This is a 3-month candle chart. So each one of these is a quarter of price action. So you can see over the last pretty much year, we are just compressing and compressing and compressing within this falling wedge here. And a lot of the time, compression leads to extreme upside moves. Baidu has the personality to do that. I'm in shares because I also know that Baidu could go down 10% in a day and not even blink, right? That's just the personality of Baidu. But if you look at all of the lower indicators, I know we've gone over these indicators before in previous shows. We have the MACD showing divergence actually on the histogram, which is kind of a rare form. But if you turn on the MACD and the signal line as well, you can see that the MACD is starting to curl to the upside, i.e., the blue line is getting closer to the signal line, which is why you have these pink lines here, because the distance between them is getting smaller and smaller. To remove the noise, sometimes I just will completely turn off the MACD and the signal line, because this is all I need to know. I need to know that there's divergence here. We are compressing on the MACD. The RSI here, you can see as well, we have these lower closes. So pretty much from April of 2024, we have a slightly lower close from this April on the quarterly chart. However, you have a higher low on the RSI. You have the Williams percent range also printing divergence, oversold. So for me, the risk to reward here is just totally worth it, because I think this could easily have a one candle move to 116 to up to 120. But keep in mind, a one candle move is 3 months on this chart because it's a quarterly chart. So Baidu is definitely way up there for me on the watch list. And I have a position. I started yesterday, but it's only shares because options, the spreads are huge on Baidu. I'm not really trying to deal with a 10%, 5%, 10% spread, whatever it is, depending on what contracts you're buying. I'd much prefer to just hold shares. Shares have a lot more intrinsic value than options. Options have a expiration date. Shares do not. And I can always sell covered calls on this if it gets a big move up. And I think maybe in the short term it's topped if it goes up 15% in a week or two. But yeah, that is a big one. But I kind of want to discuss the elephant in the room as well, which is Oscar. Arguably, maybe one of the most crowded trades I think I've ever seen. This is a name that did look pretty decent last week. I decided to take a stab at it for about 90 minutes on Friday before I realized once again I was breaking my rules, trading a stock that every single person on FinTwit is talking about. Generally doesn't work out that well. And I am in bull, so some may argue bull's the same way, but I think bull's a completely different kind of thing right now. Healthcare in general does not have the sentiment at all, and the headwinds for healthcare right now are definitely there. I mean, this thing, I hate to say it, this thing could definitely be me moving down towards this 1120 to 1165 area. Regardless, I'm not going to touch it. It's just not one of those names that until everybody starts posting how much they hate this stock and it's going to zero, then I'm probably going to avoid it. Like I said, this was an idea for me for about 90 minutes on Friday, and I was just like, no, what am I doing?
What did you see or witness where you were like, I'm out?
The fact that it couldn't hold its bid at all. We did have a nice little pop yesterday, but that also wasn't couldn't hold. So what I did was I had the shares, and I was like, okay, I'm tying up way too much capital in this position. So I entered a very small options position in case we got the pop, which we did. And even the contracts didn't move. I had the $14 calls for this Friday, and they weren't even moving, and they became in the money. So I'm like, okay, this is not something I want to deal with. But the main thing, if you want kind of the signal that I was seeing, pretty basic signal, and I know we've discussed it a bit. On Friday, even though the price dropped, you had an uptick in the percent range. So that was the reason why I was like, oh, maybe this is good for a short-term pop to this anchored VWAP from the July 1st pivot around 1560. But who know, the price has been all over the place pre-market, so I don't know what it's at right now. But overall, think the last time I heard it was like down over 5%. If that's the case and we do break this low of 1305, which I think we have pre-market, I think we are probably going to revisit these lows in the mid 11s. The options flow was extremely bearish last week, very bearish. So, a lot of the time you got to follow that flow. It's not something I've used as much as I do now, but I am starting to realize that, options flow, especially looking at things, trading what's happening at the ask, is really important. And a lot of puts were being bought at the ask last week for pretty far out of the money, $10, $11 puts below. So, it's starting to look like, of course, somebody always knows. I don't know if anyone's watched The Christmas Story, and there's that part of the movie where he's like, they're talking about Santa, and the dad's like, he always knows. Well, somebody always knows in the market too. I hate to burst anyone's bubble, but yeah. So that's OSCR, and the last one I'm looking at, and you could argue that this is a crowded trade as well. I think it's in a completely different setup right now. Is Bull, Webull. I do have a position here. We had a nice impulse move. A little bit of a pullback yesterday, and yes, a 10% move to the downside for Bull is not anything out of the ordinary. I'm focusing on this volume shelf here. My upside target is pretty much from around the mid 18s to a potential overshoot of $20 a share for Bull. Another one that I won't really trade options on, at least in big size, because of the spreads. The implied volatility is also very high on these contracts, which leaves you room for potential IV crush if you don't get the move. So yeah, just sitting on shares. I may actually add today, depending on what the daily candle looks like. Just quickly, if we want to look at the Bull daily candle chart, same thing, right? I want to see some type of kind of hammer or doji forming here into the end of the day, and at that point, it's possible that I will add to this position if we do have a nice kind of candle forming right at this volume shelf area.
Mm-hmm. Yeah, that is all very exciting to watch. Well, you talked about Oscar, Jake. They did do a little bit of a readout this morning. They did a pre-announcement on Q2 2025. On the fundamental side, they announced a major Q2 loss that is expected. So operating loss of $230 million, driven by higher than expected member healthcare utilization. Full year guidance cut. Shay, I know you know a lot about this space more than most, and I know you stay clear of telehealth. Any thoughts on Oscar as a thematic investor, kind of alongside what Jake's talking about on the technical side?
Yeah, just like you said, I've worked in that industry for a decent amount of time. I am confident to say a lot of people who post about Oscar actually don't know that space quite well. I will say that what Oscar's trying to tackle, though, is very disruptive. I don't know if they can succeed, but if they do, we're talking about the Stripe of insurance infrastructure. That's a massive scalability, and it's going to be very disruptive because the way they're trying to scale into that with their tech platform via AI angle is the routing engine. I think right now the biggest headache for a lot of these companies in that space is members going to the emergency room when they could have just easily gone to their urgent care. That cost difference is massive. It's 10x. So if someone who goes to urgent care is around a couple $100, go to ER, it's a couple $1,000. Not even that, maybe they get redirected towards like a lower complication provider that's going to essentially save money as well. Like we're talking claims deflation, and that is the name of the game for a lot of these companies. So if they succeed in that, watch out, because right now it is priced is undervalued right now, and it's deserving so because it's such a disruptive product that I think a lot of people are saying there's no way. And in an insurance space, like you don't get a premium. You don't get a premium at all. I think right now, like you're paying like $4 for the actual business. The rest is balance sheet sitting in cash. I think you have $3.2 billion in uninterrupted cash. So like it is very undervalued. And like you mentioned, I am a thematic investor, so that's primarily the reason why I don't own the stock. Is I focus on sectors I have deep conviction in, and that's like my style of trade investing. Like we're talking AI, space, quantum, electrification, automation, etc. Like insurance is clearly not that lane for me. It's complex, it's low margin, and it's full of red tape, bureaucracy, BS that's might anchor just any kind of disruptive technology, which is something that Oscar has. But I am rooting for it. It is trying to become a rational player in a very irrational industry. If you're shorting the stock or you're betting against it, like I don't know why you would. Like healthcare is messed up in the US. And Oscar is kind of one of the unsung heroes trying to change that. And just know what kind of company you're investing in, though. This is not going to be a Palantir and Robinhood like move because of that red tape bureaucracy. It's going to be a slow compounder, but monitor how much it's actually going to, if their technology is actually being implemented as that stripe of infrastructure, and just monitor. Just know that right now the government is screwing all these companies up with their increase in rates. And spoiler alerts, utilization will continue to increase with these rates getting higher. What that means is the government's paying less money now for these companies, and it doesn't matter if utilization increases or not. That's kind of the type of red tape bureaucracy I'm talking about in the space where like Oscar can be executing like they are. Like they got it up on the preliminary guidance. They got it up, but their operating loss was a lot greater than expected. That was nothing they could do about that. That was purely the government increasing rates without them saying anything. Boo-hoo. Other bigger fish in that pond are going to experience the same exact issue. So I think it's annoying, but I don't think it's a bear thesis. I just think it's going to prolong the not inevitability, but like what they're trying to tackle from point A to point B. And you just have to be even more patient if you're an Oscar shareholder.
Yeah, I think it says a lot, Shai, that you know more about this industry than most people, and you're like, nah. And I think you made a good point about Robinhood and Palantir and just the removal of friction on the regulatory side for those things and the general positive sentiment support from the federal government in those pockets you identified, future of defense being Palantir, and then Robinhood. They were at the White House, I think, yesterday, very supportive of all of the crypto policy. Healthcare is such, it's just like no one wants to touch this thing. It's like a grenade in politics.
Bloated. It's bloated and slow. And I do want to call you brought up a great point, Katie, where one has a national security element, so it's going to be enforced more. The other, Robinhood, has a lot of bills that are going to be tailwinds for them.
Yeah.
Healthcare doesn't have either of those things, and it needs to be disrupted, but the bigger players have the pockets of the governments, and they won't change anything just because it's not a big rock for them. It's going to be like,
yeah, it's a landmine too, right? Like
Yeah.
no one wants to touch that. I think that's interesting. I just think it's interesting. Usually, if you know of space intimately well, you're like, okay, I can mix. You're like, nah, I don't. I'm out. Let's talk about a space I don't think any of us know that well, which is Kohl's. We're back in like meme stock land territory. We talked about OpenDoor. Kohl's is seeing a huge uptick in activity over on Stocktwits. So the message count for Kohl's, which is the department store chain, rose 7,800% in the last 24 hours. There's no news that came out of it, no fresh developments. People are, I don't know, extremely bullish on their Kohl's cash, I guess. Sentiment extremely bullish, message volume high. This jumped a little bit before the bell. I know we're not following this one closely, but I guess, Jake, you talk about a lot like watching signals for what a risk-on environment looks like. You talk about watching Bitcoin. Do you also look at these sort of random meme moments as another signal of the risk appetite of the markets overall?
I don't even know if it's a risk appetite. I think it's something that's happening under the hood with larger institutions and being maybe on the wrong side of the trade and getting called on something from somewhere else. I think that's more or less what kind of happens in this environment. And it's not really a coincidence that you're seeing these types of moves in a lot of different names. I mean, this is exactly what happened during the GameStop era. The market will decide, maybe AMC isn't the move this time, and then you find something else. And that's what's happened. So you're always going to have, these massive moves are not. This is kind of like your December of 2024 type action. You had the moves in drone stocks. That was when, drone stocks have still done well since. Over the last couple months, but drone stocks, exploded in December. You had some other names exploding in December, and that was right before the market topped out within about 6 to 7 weeks. So I'm not over here saying this is happening, the market's going to crash tomorrow. I clearly have plenty of exposure still in the equities markets on the long side, but I do have cash because I do think that this is a signal that we are kind of getting to that point where some of the bigger money is maybe being caught on the wrong side, and that's if you're really on the wrong side of the trade, it's especially if you're like shorting physical shares of something, it's very easy to, and what I mean by physical shares, you're actually shorting the shares versus just buying puts. That's when you actually start moving the market, because you have to buy the shares back, and that's what creates this huge demand. So
Sean is so emphatic. I think he's coming on the show next week. I'm excited, but I'm like, I think I need like a Xanax or something. I saw him in person on Friday. That guy is a ball of friggin' energy, but he is watching this closely in all caps. And I think his comment encapsulates that perfectly. But Jake, that's great insight on this one, and we'll be watching it. It's just interesting to see which names here just get the attraction of FinTwit and Stocktwits, and it just starts to snowball.
Well, I think you are going to continue to see these random names pop. Part of my thesis on bull is this. You have to think the chart will tell you all you need to know. You didn't have to be trading. I wasn't trading Webull when it went from 20 to 60 or whatever it was in April. All I have to do is look at the chart to know it happened. So you kind of look for these things that have happened in history, and you say, okay, well, the personality of the stock, that's just how it moves, right? So like, I would not be shocked at all to randomly see bull go to 25. At all. The market cap size is there. It's only about a $7 billion-ish market cap. So that's part of my thesis with bull. Is it's just one, BULL, bull. It's the ticker is a word, and a lot of the time when you have a meme stock, it's as simple sometimes as being able to say the ticker as a word. Open, right? It's just a psychological thing. So that's why I do think you're probably going to see money flowing out of some of these opens or some of these other things and just move to other things. Bull is one. Even like stocks like Blink, BLNK. That's a name that just has made a pretty big move recently out of nowhere, because it's an EV charging company. Like why would that be catching a bid? So like things like that have actually had these types of moves in the past, generally money, people remember that, and that's where money starts to flow. Blink is one that could probably quickly move to like 140, 150, but it's just the name is just, there's not enough liquidity for me to really trade that in size that I'd want to, so I decided to go with bull on this one.
Yeah, the ticker branding is interesting. I found out kind of recently my favorite ticker, which is, if you go to the mall, there's David's Tea. If you've ever seen that, it's like the turquoise blue. They are OTC, but they have the ticker DTF, and it's DTEAF, and I'm just like, God bless. Like, this is not financial advice, but what a great ticker. Love to see that as a marketer. I feel like no one talks about this because it's,
That's pretty funny, actually.
Yeah, it's a good one. Like some someone was like, let's do this, guys. And they were like, you know what? Let's go for it. Shay, I want to zoom out a bit. Let's talk about cybersecurity and a name that you've brought up before, SentinelOne. There's a flurry of conversations going on about them today. There's rumors that Palo Alto Networks might be interested in a merger acquisition situation. Both the companies sort of denied it in a way where you don't comment on rumors and speculation and corp speak. Why, based on what you know about the space, why would a Palo Alto be interested in this company? And from your view into this specific theme, what does that say about what's happening in cybersecurity?
It's fragmented. Cybersecurity is very fragmented. There's a lot of offerings. I think there's a lot of different tiers. There's not that many tier ones. There's a lot of tier threes and some tier twos. And I think that SentinelOne, they have really interesting tech. Like they really do have a really interesting lane and endpoint. They've had an awful go-to-market strategy. It's been a very mixed bag. When your biggest competitor shuts down the world for a couple hours and finally opened the back door of like maybe you can get into the room with those conversations and these clients that you weren't able to because CrowdStrike just had such a premier product. They weren't able to really extract any clients from CrowdStrike. Tells you everything you need to know about how valuable endpoint is in CrowdStrike's offering, and the value proposition that SentinelOne's offering or their strategy just wasn't at par where it needed to be. And seeing that CrowdStrike was like 25% higher than it was pre-outage, SentinelOne, if you zoom out, like was it July? If you would do more than if you want to go to the 5-year, because I think I have to see July 19th last summer was. It's essentially the same point it was. They didn't really gain anything, and you can make the argument that the multiple actually contracted because they've grown the revenue since then. So I think for Palo Alto, it's a no-brainer. Their whole strategy has always been land and expand, sell that platformization language that they love to say every earnings reports. They have a lot of blue chip customers. In order to keep those blue chip customers, they constantly acquire the latest and greatest. Endpoint offers that to them. I think from a SentinelOne standpoint, I don't know why I would sell yet because we are undervalued. It's no secret they're the cheapest cybersecurity platform. Sorry, the most undervalued cybersecurity platform in that whole space, especially against their peers. But it is priced accordingly because they've proven their go-to-market is weak, and in an industry that is highly competitive, that is the name of the game. You need to be able to sell your product. It doesn't matter how great of a product you have to be able to sell it. They have not proven that ability yet or if ever. So I do think that SentinelOne is going to be an acquisition target eventually. I called it out before. I just don't know if right now is the time. But if they see that things aren't going to get better, that AI tsunami I'm referencing for quite some time is maybe a lot closer than a lot of people anticipate. Maybe they want to sell it right now. And for Palo Alto, it's a steal. For SentinelOne shareholder, you have to be frustrated because you were bidding SentinelOne from $25 to $30 when CrowdStrike's at $200 post outage, and now CrowdStrike's at $500, and you're in the waters with SentinelOne stock price. So this is a great example, business case example. Invest in the best companies in the space. Second fiddle is not always the best solution. Don't have valuation be the primary weight in your decision calculus when you want to make an investment. It needs to be about moats. CrowdStrike, SentinelOne is a classic example. However, I don't think it's really that real. And the reason for that, CrowdStrike would have gone down much more if there was some substance into it, because this is a product portfolio expansion for Palo Alto that might step on the toes of CrowdStrike a bit. So it would be a net negative in a way for CrowdStrike if Palo Alto had a competing product into their whole platform. And we didn't see CrowdStrike stock price move at all from that news story. And you also saw SentinelOne completely fade that move. So I think it's more of a, I don't even think anyone reported who it came from. I think it was just somewhere in the ethos. So I think actually it was on the CNBC studio lots in the show when they announced it. I was like, what? And I went on my phone and apparently it was out. And I was like, geez. So I don't know. I don't think it's too real. So I think it's eventually going to happen, but I don't think it's happening right now.
Hearsay and conjecture. That's funny. You're like on the studio and you're like, what's happening? That just seems like the way it is now. You'll roll on the set, you'll be prepared, and then you'll open your phone and it's like some fresh headline that you need to react to. Jake, I know you mentioned in kind of like your preview of today's show, you mentioned Nike.
Yeah.
So I'm curious your thoughts there. Before we get to that though, check out these new Air Maxes they're dropping. This has nothing to do with the financial markets and it's not investment advice, but they're back. I feel like Nike's back in
Oh,
their
wow.
bag, right? Those are sick.
Skechers. It
Well,
looks like a
I think
Skechers
they're.
shoe.
Oh, you wouldn't, Jake? I would. I
I
very
mean, I'm
much
not saying I
would.
wouldn't. It just looks a lot more like a Skechers kind of
Yeah,
80s vibe.
yeah. The headline said or described these as thick shoes. THICC.
That is such a weird way to frame those shoes.
I know. I spotted these and I was like, all right. But Jake,
Wow.
you're not looking at the thick shoes. You're looking at the charts. What are you watching over at Nike?
Well, I would say it's, very similar type thing. You'll kind of notice a lot of the time I have a very, very kind of just setup that I try to find over and over again. Same thing here. If you anchor the volume profile pretty much from this low in April, you'll see we've got a pretty solid volume shelf set up here. So the problem is if you're anchoring from this point, you're only measuring, where's the actual lows here? You're only measuring what's going on from this range to this range. You don't really have any information about volume above that. So this is when I would actually pull the anchored VWAP here, because then we can get an idea of, is there any volume that occurred at a higher price that may act as resistance. But, for now, I think a retest of these previous highs from 76.40 to 77.50 is, seems like the higher probability at this point. You've got a nice move off the volume shelf. You got this little gap here up to around 75.85. But I mean, overall, if you zoom out, this chart's gotten destroyed. The move hasn't even really happened here. I mean, we got to keep going out. My gosh, yeah. So this is not going anywhere. Nike is going to continue to do its thing. So if you look at the move relative to this, you haven't even really made the move. And if you look here, there's a ton of gaps above. There's a gap above at 87.70. There's a gap above at 93.15. There's a gap above at 121. It's even a gap above way up here at like 156. So, I mean, I think this is kind of in the process of a long-term bottom. I think yesterday with the new kind of what you've already won thing with Scotty Scheffler, I think, that is kind of changing the status quo for Nike a little bit. Whether anyone wants to say it or not, I think, Nike definitely had a problem with the whole, they just got way in the political side of things. I don't think it helped them out too much. Mm-hmm. But if you look at the longer term side of things, let's see, anchor the view up. Where is it? I have to anchor it here apparently. Yeah. So, I mean, if you look at the 3-month candle, the quarterly candle, you had a huge hammer here. This is likely your capitulation. If you want to quickly just take a very basic approach to trying to draw a falling wedge here, you've got a pretty decent kind of falling wedge setup. So yeah, at least for me, I would say you're pretty close to a pretty strong breakout here on the long-term side of things. Like I said, this is a 3-month candle. So, if it breaks out in December, that would technically be the next candle. So just remember, if you are looking at time frames, know your time frame. Buying next week's expiration on a 3-month candle setup is, you're pretty much just giving your money away at that point. But hey, if people don't like money, that's their thing, not mine. But yeah, so I think Nike is probably pretty close to a pretty significant upside move here. You've just had this very kind of controlled move down. Like I said, Nike's not going anywhere, so I think Nike in general. I mean, if you anchor the VWAP from the all-time high here, the anchored VWAP's at 95. I think you could easily get a mean reversion move back to like 95. So that's
Interesting. Yeah, that's. I mean, it's so funny. Just like you're in the charts, and you mentioned Scotty Schefter, the ad they put out. They are like back in their bag, I think, in terms of building the brand. They keep releasing new products, such as the thick sneakers I mentioned. But here in the technicals, a different story than you see in the headlines. So interesting to take a look there, Jake, on Nike. I want to quickly jump over to some headlines coming out of Coca-Cola this morning. They had their earnings, and they are referencing that they are going to use or have plans to use a new drink made with cane sugar. Now, I'm not a big soft drink drinker, but they currently, in their core product in the US, they use high fructose corn syrup. This has been sort of catching the ire of the Maha movement, if you will. I wish we would stop making anything great again. I feel like it's dead. That's done. We've done all of the things, but Maha is the name of the game for RFK. And so they're releasing this new product. Now, this is, if you have, Coke, they call it Coke Red within Coca-Cola. They have a whole portfolio of companies they own. Coke Red is the core product. It is different in the U.S. If you go to like Mexico, people say Mexican Coke just tastes different, better to some people. So Trump pushing them to use cane sugar. I didn't know what they were putting in there, frankly, myself. We are learning a lot of new things by the day, but interesting to follow this, because I think on the soft drinks, a lot of the focus on sort of zooming out on the consumer behavior has been on sparkling beverages, growing the portfolio outside of their core Coke Red product, whether it's a water product, energy drinks. But I don't know. Have you guys ever had Mexican Coke?
It's the best.
yes, I have. And it's very
Mexican
good.
Coca-Cola, I will say.
Oh,
I'll just
sorry. My
specify
bad. Sorry. No, it is the best. I was referencing that, obviously, but
Obviously,
So-
it is better. Yeah.
no, you can taste the quality. It actually tastes like, I don't know. There's an artificial taste. Oh, that's what that taste was after you have a Mexican Coke. You're like, so I think that I think it's really interesting, like, the trend though in the drink strike, because like Pepsi had a probiotic soda. I think that got released yesterday. I think that
What?
yeah, they had a probiotic. That's a these I forgot what brand got bought out. That's kind of like It's not bubbly. It's something like that.
Oh, Poppy.
Poppy. They got bought out for what? What was their valuation? It was like $1 billion, I think, or something.
I don't know. I
Very
think
crazy.
Poppy's trash. I'm like LaCroix girl all the way. I'm not veering from that. Coconut LaCroix is disgusting, and I love it.
No,
Uh,
it's still a trend though. Like I go to Air One all the time. Their whole
Yeah.
aisle is like 5 different brands, and
I know.
I still think Pepsi and will have an issue selling a healthy gut drink just because of their brand. I was like, it's so Pepsi. Something might be off. I'm not going to trust.
Probiotic soda is weird. Like
Yeah.
we don't want those to get. I don't know if there is a like this functional beverage thing. First of all, the margin on these sparkling drinks have to be insane. It's literally just water. They put it in a cool can, pay for the branding. I'm getting really into this iced tea brand that apparently Morgan Wallen backs called Ryle. Ryle iced tea. I'm just gonna. They do not sponsor this show or me. This is good stuff. But it's antioxidant, zero sugar iced tea. If you're into that kind of thing, it's random Morgan Wallen's like, yeah, I'm gonna do the iced tea thing. But I guess that's where we're at. Do you guys what sparkling beverage brands do you guys rock with?
I'm a placebo guy, so I love these gut drinks for sure.
Okay.
I am the sucker who goes there. I love sparkling water with lime. Like that's my go-to.
Yeah.
Not great for the teeth, I will say, but it's worth it.
Is
for
that
me.
real?
It's very real. I think so.
Oh
It's
shit,
like-
I'm done.
Yeah, you can't suck a lemon wedge or like have lime too much, acid. Same with the soda, it messes your teeth
Oh,
up.
no.
But either way, functional beverage is the new name of the game. So I think that you're seeing the younger demographics. They want to focus on longevity of their life more and more. Less people are doing killing their liver with alcohol. They're doing alternative vices like marijuana. I don't think they're smoking as many cigarettes. Heroin use is probably way lower, etc. So like I think that is a trend that if you're a consumer brand, that is the name of the game. You have to stay up front of the latest and greatest. Even Celsius is feeling that pressure. Like they used to be the growth story. Now they're the company acquiring the latest and greatest. That shows how quickly things can change. Like what was it? They had a 3 or 4 year time window when things were like, this is the next monster. Not even a full presidency. Then they had to convert into the actual mature company because things changed that quickly. So like it's a brutal space to be in. I don't advise at all. Like why would you risk just like in being in that consumer beverage space? It's just too fickle. But yeah, these companies have great dividends, I guess. Pepsi, Coca-Cola, and people have brand recognition. They feel safe owning it.
Yeah. I'm just catching a headline that caught my eye. We talk about just IPO appetite, M&A. I feel like things are happening. The record label behind Taylor Swift and Drake, Universal Music, is apparently has plans to list in the U.S. They're already listed in the Netherlands, so it's another example of people going out, liking what they see and sticking their neck out there. So UMG. That will be an interesting one to watch. They also rep Ariana Grande and Harry Styles. So more activity on that front. Let's turn to sort of the rest of the week ahead in sort of earnings. I know, Jake, you said you don't chase the earnings so much, but outside of what you shared with us, anything else in particular that you're keeping an eye on or that people should be thinking about as they head into the trading week?
Yeah, I mean, I think we're kind of seeing it right now. You're seeing the market go, pretty hard to the downside. This is definitely when I start to, I know we've been talking about this for a while, at least the last two shows, but this is when I generally like to go a little heavier on the share side, the cash side. That's kind of what I've been telling at least my subscribers is like, hey, this is the time of the year where you have an overextended market. You're going into a seasonally kind of turbulent time. Happens every year. And if you're going to be trading the same way you did the last 3 months, then you're probably going to round trip all of your gains for the last 3 months. So this is definitely a time where I have cash on the side. I have shares. If I have to deal with a 10%, 15% drawdown on a shares position, that's like a walk in the park when you're trading options. So I sleep a lot better at night having mostly shares and some cash. And I still do have some options positions, but they're long dated. They're for October. I have some for September. But yeah, definitely I think the time is now to be cautious.
And Shay, are you in New York, by the way, Shay?
Yeah.
Welcome to New York. It's been waiting for you. What do you got? I wanted to do that for so long. What do you have planned for this week? What's the tour look like?
Yeah, so CNBC yesterday. I then went to some board meetings, and then I have Bloomberg today. I have Schwab tomorrow, The Street tomorrow, Fox tomorrow, and then I have Yahoo on Thursday.
Okay.
And that's a fun one. That might be a prolonged one where Dano and I might be on together. So I'll be a little
Uh-oh.
But yeah, it's tech earnings. So like this week's very busy. Clearly they want tech people who speak on tech to be on the media circuit, and I think that there's a lot of angst on what this earnings cycle will be because of the run up we've had. It's purely on a multiple expansion, and people were like, is this the time to take your chips off the table? Because when a market's at an all-time high, typically the VIX is below the mean, is usually at a 12, 13, 14. It's still holding up at 16 or 17. That shows that there is some hedges in place still. People don't feel fully comfortable with the environment yes, there is a sandbox on tariffs, but they just don't feel confident that it won't get worse. There might be a headline or two. And I think that right now you have to zoom out, ask yourself in an earnings cycle, what has ran up and what's being priced to perfection, and what do they have to deliver to actually hold that stock price? Netflix is a perfect example last week. in really strong prints on Thursday. They were priced at 60 times earnings, and that's why they're down 5%. It wasn't strong enough. And that's why I think this earnings cycle, we have Google under 20 times earnings, the most undervalued Max 7 names. They're going to show that the AI cannibalization on search is a lot worse than actual reality, and maybe they catch a bid. Tesla, it's also an underperforming Max 7 name. But we have names like Microsoft. We have names like the other like Meta, and we have all these other names that have ran up. Microsoft especially because they're very expensive. Like you have to ask yourself, what can they deliver to justify the price? And it's going to have to be very lofty. And Apple is left for dead. So maybe next week we'll be like, it wasn't that bad. So I think zoom out, be patient, take some chips off the table. We have some names that have gone up a couple 100% in like matter of weeks. That shows that frothiness. So be cautious.
Yeah, I mean, I think this is the tech earnings. Apple specifically, that's one where I'm like immediately going to go to the transcript and read the analyst Q&A because I think they're going to kind of knit at some of the topics we're talking about. It'll be very interesting to watch. We also have Powell speaking tomorrow as he's continuing to be under fire. I don't know why he doesn't just put his hands in the air and say, you know what, you people don't appreciate me. I'm going to go to my Grateful Dead shows.
I called him the mom of stock market. He delivers, but it gets underappreciated.
Orange slices. He's got the orange slices, and everyone's like, Mom.
Those were the days.
Those were the days. We need to go back to that. Guys. Go ahead, Jake.
If I could just say one thing. One, seasonality, market's overextended. But two, just if you're trading anything, make sure you know what is coming up on earnings. Like one, brutal if you're actually holding a stock and don't realize earnings is like tonight. Two, it's even worse when you have a stock, it looks great, and then someone in the sector, competitor, partner, whatever, comes out with the earnings and the stock gets absolutely nailed. Not because anything happened to that stock, but something happened to the stock that had earnings. So you have to kind of be playing a little more chess right now. You can't just be thinking about what do I own. You have to be thinking about what is coming out in the earnings in the next couple days that may affect the stock indirect or directly, but you're not actually, indirectly, but you're not actually owning the stock and you're still can get blown up. So
situational awareness
from experience.
is key. Yes. And that's a great plug for the Stocktwits earnings calendar, which is a great resource. And I open it every morning to see what's going on for a quick view. Guys, we will see. Well, Jake, we'll see you back next Tuesday, I assume. This is now your day. Shay, good luck with all of your TV hits. Definitely, if you're tuning in at home, follow these guys this week. Watch their commentary. Smash that like button. But thank you both for your insights today, and to everyone else, we will see you bright and early tomorrow with another big earnings day on deck. See you guys.